Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for March 10th of 2024. Well, as we get started in this spring break / South by Southwest week, we've got a few charts here. I'm going to talk about sentiment first, kind of get into the investment markets, and then we'll kind of backtrack to the economy, kind of like reverse it up from what we usually do here. But we've got two charts here on sentiment, really one pertaining to individual investors. That's the AAII, American Association of Individual Investors. See, sentiment is up. You see the red dot, so that is clearly moving higher. And then we've got the name number, which is the National Association of Active Investment Managers. And see that blue dot over here, also fairly high. So sentiment overall in the investment markets is actually very positive. And kind of a follow-on to that, we've got a chart here showing that we've got really strong inflows into equities right now. You can see the trend line here. This goes back to 2010, and the ebb and flow is usually not, terribly pronounced. Obviously, we had a huge inflow when we got everyone got their stimulus checks, and we were coming off of the pandemic, and there was kind of a jailbreak, so to speak. But clearly, we've been in an uptrend here in terms of fund flows into equities. Consequently, we have more days with new highs in the S&P 500, and you can see that here's a kind of a peak line here, if you will. Of course, we punched through that, at various points. Really, almost, at points that, correspond, after the fact with periods of kind of like retrenching. Of course, we have the, long-term capital. We had the Russian ruble issue in '98. Now we saw a spike in new highs before that. And then heading into '08, we had a similar spike there. And then in 18, before we had a little bit of a correction. And then obviously here in the pandemic, post-pandemic phase. And, we've gotten back up to that level right now. Question is, what does that portend for the markets? And obviously we see a lot of money flows coming into the market. On the last chart, we see sentiment pretty high right now. Everything's kind of seeming a little bit Pollyanna. We'll talk about earnings in a second. But I do think the market is ripe for a bit of a pullback here. That's not to say that we can't continue to have a reasonable equity performance, but it would certainly argue for some type of a pause here in the near term. We've got a percentage of current S&P 500 members that are outperforming the entire index, and you can see here that number's really dropped, and like over time, if you go back to basically 1994 and then trend line over, we're at a pretty low period right here. So, we were talking about this time last year about the lack of breadth in the market, and then that seemed to improve a bit. And but we're back at levels now that are pretty striking when you consider that you only have 24% of the S&P 500 constituent members that are actually beating the entire index as a whole. Talk about profit margins. This is non-financial corporate profit margins. This is a story that's been playing out for a number of years, in fact, decades almost, really. When we got into the tech bubble, and then productivity picked up with technological impulses. You see the trend line, the line of best fit here is clearly moving higher. We have rolled off the top a little bit. We've been talking about the, I guess, questioning the sustainability of, almost near record profit margins. You got to go back to mid-1960s before you see a corporate profit margin level the likes of what we have now. The question is this a little fishtail hook that then meanders and then kind of remains steady, or are we going to see some further erosion? Now, honestly, the surprise is when we had inflation, we felt like we had enough inflation that it had to be passed along to consumers, in fact, it largely was. We had consumer-based inflation that was being channeled through production, and so it was less of an impact on margin. But this is a pretty impressive spike, and we've had impressive margin spikes in the past. It's just an open question right now of how sustainable are these. Now, if we do have a soft landing and the economy improves, and obviously I think that is going to be more sustainable. But when we're talking about maybe a little bit of a slowdown here, this would seem to indicate that. We have earnings versus inflation. Obviously, talking a lot about inflation. We got in the kind of this purple line, we've got the CPI inflation number over time. Here's 2020, so we had that acceleration in inflation. And we also had an inflation in forward earnings. Now, we've had a reset. This is 2022 in that weak period. And then 2023, we saw those forward earnings expectations begin to reaccelerate. And so this is the mother's milk right here to what's going on in the market. As you've got earnings expectations that are moving higher amidst rising inflation. Now, granted, this is the CPI number. This isn't the year over year. So, this is essentially on the CPI on the right side axis here. This is just an aggregate number. So inflation continues to increase over time. It accelerated, but this is not the year over year. So this, from an index level, is clearly moving higher, as it's basically 2012 is the control year in which that was 100. So now we're essentially about 136-ish on the CPI index relative to 2012. And so forward earnings have moved up in tandem, more volatile, of course, but moving higher. More earnings analysis here. On this chart, we've got basically the S&P 500 in this line right here. We have the Magnificent Seven. This is 2024 earnings per share. Again, the same story that we've been talking about. That very narrow select group of stocks has had earnings increases tied to artificial intelligence, whereas the rest of the index is seeing worse performance in terms of earnings. And so, this is contributing to the data in the chart that we saw a few slides ago, where only 24% of the index members are actually beating the index. And this is why, because there's a lot of companies that are being left behind. Selectivity is very important right now because not all boats are being lifted. Essentially, a lot of the market is being driven by these. Now you can see the influence here. And here we have from Charlie Bilello kind of an overview of earnings growth on a quarterly basis, year over year, representing about 98% of the S&P 500 that has reported their fourth quarter of 2023 numbers. We're pretty much done there with the fourth quarter earnings season, and you can see here very clearly that we've had positive over the last several quarters, and the risk that we were again pricing into the market for quite some time was that we were going to have earnings growth become negative, that we were going to have that that recession. That didn't happen. Earnings have continued to increase at a reasonable clip, which again is providing more feedstock into and fuel into continued equity gains. And then I think we'll put a bow on things with this slide for this part of the presentation here. This is essentially the NASDAQ, the NASDAQ 100, and it's the contribution of the total gain in the NASDAQ from a very, very small handful of companies. You can see Microsoft, Amazon, Meta, NVIDIA. These four stocks in the NASDAQ 100 have accounted for about 9.2% gain, actually about 8.7 if you go back to March 7th. But the rest of the NASDAQ 100, basically the 96 other companies on the NASDAQ 100 have actually been down. So they've contributed negatively to overall performance. And it's really these four stocks that have done all of the heavy lifting in that particular index. This chart is very interesting. You know, it looks at a 10-year average PE ratio, price to earnings ratio. And then here's kind of where we are as of the beginning of last week. And so you can see the various components of the market. You know, we've got the S&P 500 overall. You know, we're above this trend line. So this line represents the difference between that which is viewed widely as cheap relative to its 10-year average on this side, and then all the ones on this side are expensive relative to the 10-year average price to earnings ratio. You can see here growth. This is what we've been talking about, the Mag 7. You know, these companies that are driving the market, as we saw literally in the last chart with the NASDAQ 100. You've got the overall S&P, which is heavily influenced by these, right? Because the top 7 accounts for 30% of the index. And again, we're talking 500 companies here. Momentum, kind of the same deal. Interestingly enough, we've got the dividend aristocrats that are slightly above this trend line and equal weight, which has really lagged, or certainly lagged at the beginning of last year, caught up a little bit. Even value slightly above its 10-year average PE, and then based on revenue. And then here, which is really interesting, we are emphasizing this at least in international investing. That's low volatility. And then you've got the S&P 400 mid cap, and then the S&P 600 small caps. So we've talked about small caps being a bit more attractive, certainly from a valuation standpoint. And so if we did have I'll call it maybe a 5% correction, then you get, you know, your dividend paying companies and your equal weight, and then kind of your capital strength. You know, you get those people really coming in line to a 10-year average, whereas you'd have to see a rather significant reset in growth to get them to be anywhere near cheap as an investment. So looking at valuations here, going back to that last slide, this is represented a slightly different way. Here's your overall S&P 500. You've got 20 times earnings. And here you actually have a 20-year average. So this is looking at it relative to a longer average than we were looking at in that prior chart. So 15.6. So the S&P 500 itself overvalued relative to a long-term average. Equal weight, if you back out the Mag 7, you know, even though we haven't seen a tremendous amount of earnings support from that group, and certainly from a price momentum standpoint, but here we're a little bit overvalued relative to its longer term averages. But just as we saw in that last chart, when you get into mid and small cap stocks, they're below their long term averages. So this is reinforcing what we saw in the prior chart, kind of reinforcing to us, you know, where some of the pockets of value remain. Really the outstanding question when you get to these is, you know, where is that catalyst going to be? And certainly if you start to see a little bit of relief in interest rates, then that's going to provide the fuel for these to begin to outperform. Well, this slide, kind of as wonky as though it may be, really speaks to the contrarian nature of market behavior following periods of outsized optimism on the part of the analyst community. And so here on the x-axis, we've got long-term estimated growth rates that are put out there by the analyst community, and then here are the expected returns over the next 12 months. And so, you know, we've got a lot of observations here, and this is kind of noisy, and so this line of best fit is really, you know, there's not a high degree of correlation here, but it is informative in the sense that here's a zero line right here. And so, this would infer, observations here would infer that the market's going to be negative perhaps over the next 12 months. And we see here the market as it was priced in early 2008 was certainly, this was very telling in the sense that the market in 2008 did drop quite a bit. And here's our tech bubble. And here's the current environment kind of reflecting this theme of the Magnificent Seven that we've been talking about in prior slides. And, this on its face, with the expectations being rather rich here, would suggest by this analysis that we're going to have perhaps slightly negative equity returns. And, that might be, the case. That's obviously, in the range of outcomes, as we say, because there are things that we don't know that haven't happened yet. But be that as it may, I think this is probably reflective a little bit more of maybe the risk of an interim correction, not necessarily, a downturn, but maybe, having a correction of somewhere around, 5% or so, I think would seem reasonable in this environment. Now we'll talk about the debt markets for a little bit. Here is a chart that is a little bit counterintuitive, certainly something we wouldn't have expected to see this time last year, but we actually have more net upgrades of credit issuers than downgrades. And so this is kind of reflective of an improving economic environment where there's, less risk of default, but very, very compelling in the current environment. So now we've got a slide here. These are estimates. These are consensus estimates, basically, of consumer price inflation. Here's a CPI. This is actually in a chart pack from Charlie Bolello. So we get to February data. We'll get that relatively soon. Expectations are 3.1. And then March of 2024, we're expecting maybe a slight uptick to 3.3 in inflation. And then we've got the core that's kind of holding in there about 3.7. Personal consumption expenditures, which tend to track lower than the CPI figure, holding in there about 2.4, 2.5, and then core PCE about 2.6 to 2.7. And so, core PCE is what the Fed looks at. Clearly this is still above 2%, but as Jerome Powell, chairman of the Fed, mentioned in his remarks to Congress this past week, that we're a lot closer, in his view, of having the corroborating evidence that allows them to feel comfortable in reducing rates. So with that in mind, here we have the chart of kind of forward expectations for the Fed funds rate. These are short-term interest rates. These are the ones controlled by the Fed here. Currently, as you can see here, we're 5.3%, and basically about 4.3 by the end of 2024. And so when you think about that, that is a rather dramatic drop of a full percentage point, which, again, estimates have really gone out the window for, any type of rate decrease through at least June, maybe even July in the latter half of the year. But current expectations are for roughly about a percentage point drop, which, again, if it doesn't happen, then there could be some negative implications on the equity markets in terms of increased volatility. But you can see here that the path of best fit as we get down to the end of 2025, we're about 3.6%. This is highly speculative, and it is apt to change. Clearly, we've seen a lot of change in the slope of this chart, over the last 6 months, and I wouldn't be surprised to see it change quite a bit more over the ensuing 6 months. Some various charts from Bloomberg. Here we've got a lot of fund flows into bank loans, government and treasury, money market, commodities, gold and silver. We've got a lot of fund flows into these areas that, oddly enough, you wouldn't see a lot of fund flows into treasury with the optimism level that we have right now. you clearly would see, fund flows into bank loans, things that have maybe a less secure credit profile to them. But you can see that these fund flows are actually very, very strong. And then Bloomberg surveys, which markets within credit will perform well in the next year. We've got private credit here, so that's something that we have been emphasizing. Also high yield bonds, as we saw credit upgrades exceed downgrades in the prior chart. So you've got a lot of optimism there. And then on commercial real estate, something else that we continue to monitor, there is fairly strong pessimism that persists within commercial real estate, primarily because of the office market. So we talk about the yield curve and expectations for short-term rates coming down slowly, here over the next couple of years. Now, if it does pan out that they come down a little bit faster, that will provide a lot of impetus for the equity market, and I think all bets are off at that point. But we're in very unusual territory, and you've got to go back to like 1980 to find a period where we have had a longer period of net inversion of 2 to 10 year yield curve, which means that the 10-year yield is below the 2-year yield. That's what they call an inversion. And right now we've been inverted for 413 consecutive trading days. And you've got to go back to 1980 to find a period that was longer than that. And usually this has led to recession. You can see, in periods of the early 80s and then, late 80s and then into 1990 where we had a brief recession, 2000, 2008. Guess what? Those were both recessionary periods to some degree. And, but we haven't had that here. And so that's the big question mark is where are we going to go in our economic cycle? And I think the consensus now is that despite this kind of forward-looking indicator, that we're set, fairly adequately for a soft landing. Now we look at the muni sector, municipal bonds. Typically, you can see muni yields as a percent of treasury yields. So just think of the best way to describe this here is, maybe just looking at longer term averages. And so you look at the 10 and 30 year, say 30 years probably more apt. But, think about municipal income as being tax free. Treasury income is obviously not. And so typically, your muni yields will be kind of a factor of your tax rate. So if you have a 25%, effective tax rate, then you would think that muni yields would be, not perfect math, but just think of it as being like 3/4 of what Treasury yields would be. And right now it's about 60%, and that is looks a little bit rich to me because if you kind of gross up municipal yields by the tax rate, again, you're not paying tax on muni income, but if you gross it up by that tax rate, you're still not getting up to where treasuries are trading right now, and that would indicate that munis are trading a little bit expensive. Quick look at some other economic data as we kind of like meander away from the interest rate markets, whatnot. We've got material input costs, and those have come down quite a bit, even though the rate of decline has attenuated somewhat, but we're still in a period of decline, which is good for manufacturing. We'll talk about services in just a second. Here is services PMI, which is still positive. Again, anything over 50 represents expansion, but we're in this kind of channel right now, and the last data reading was slightly below the estimate and also down in the aggregate. Good news here is we've got new orders that are spiking. Those were ahead of expectations, so feel like even though the current environment, and again, I'm not going to say this is negative because this still represents expansion, that it is poised to improve as we get a little bit farther along here in the year. Here we have input prices continuing to go down. This is the continuing theme of moderating inflation. Something I thought was very interesting was the explosion that we saw in 2020 of new business formations. And these are essentially, LLCs being formed, people that are being displaced, or taking on a second job, forming an LLC to do something as a home business. And we saw that spike and then saw a little bit of a correction, a couple of periods of like spike and correction. But, the latest series of data, I haven't looked at this in a little while, is actually very compelling. So small business growth is very consistent with economic expansion. Again, more evidence, I would say, for a soft landing here. We've got a business employment. So this would be a percentage of respondents saying that that employment is going down, so that number is moving higher slightly. Basically the read here is that we do see some slowing in the labor market. I think businesses are perhaps getting a little bit more cautious, even though the market itself is really tight. And we're going to talk about labor here for a few slides because even though it seems to pop up just about every week in the chart pack, I've ran across some really good research that's pretty insightful on the current issues within the labor market. Here we have revolving consumer credit. We've been talking about credit exploding following the pandemic. We do see it continuing to be positive, so this is reflective of 8.5% year-over-year growth in just overall revolving consumer credit, and of which credit cards is a piece of that, but not necessarily all of it. So again, we're still above that zero line, so credit is growing at a pretty strong clip. Now we have credit card balances on a year-over-year basis. We see those being exceptionally high. You've got to go back, to 2000 and 2001 before we saw that. And usually you see spikes in credit card balances, during periods of relative economic stress. In 2008 we saw a spike there. 2018 when we saw a little bit of a choke point in the economy, but nothing to the degree that we've seen now, which itself is driven in some measure because of the massive decline that we took following the pandemic. And so here we are at 14.5%, pretty strong credit growth. Now we have overall credit debt, which is moving higher. We've got about $1.1 trillion net expansion. So you can see the rapid expansion in credit. Really is almost parabolic move in credit following the pandemic shutdown. Well, and with some measure of economic tempering here, you're going to get higher delinquency rates, and this is the highest level that we've seen since 2001. This data goes back to 1991. You can see that this channel was much higher than what we were used to over the last decade, and so obviously credit was a lot cheaper. But we do see delinquencies moving up. Is it a crisis point yet? No, because we're still not in these levels right here. But the fact that it is moving up at a period in which we're seeing kind of increased bankruptcies and whatnot just shows you that the market is kind of turning over a little bit, and consumer might be a little stretched. So, as we talk about consumer spending and the ability for consumers to buy stuff, when their credit card balances are high, and as we're about to see, credit card interest rates are going through the roof, that, you're seeing a little bit of natural stress, which is entirely expected. Here we have the average interest rate, again from Charlie Bolello. Very compelling data here. You go back to 2000, and then you track across. Obviously, we were dealing with fairly low interest rates overall. That regime is now over, and we're looking at credit card interest on outstanding indebtedness, revolving credit. Very, very expensive right now. So another chart that I thought was pretty interesting is you look at the consumer, the health of the consumer, the ability for the consumer to continue to expand their consumption. What was really interesting here is ever since like 2010, following, we don't really see the impacts here as much of, the global financial crisis because it's more of an institutional downturn. But this is the average credit score in the U.S. For individuals. And you can see that following the global financial crisis and the ensuing slowdown, that we've had this kind of meteoric, explosion here in credit scores. And right now, we're sitting at about 717, and near the highs that we've seen in many decades. Now it is rolling over. We don't know if stresses and credit cards and things like that, what that's going to lead to. But obviously, we know that those are things that typically get handcuffed when you're building a credit score. So we'll have to monitor this. But it is interesting that consumers overall are at a fairly strong credit rating basis right now. Here we have more data on the revolving credit and some perspective on this too from Bloomberg, which I think is all very relevant in this environment. So here we have revolving consumer credit as a function of disposable personal income. And so as we look here, here's the pandemic, and we've recovered, but not to the levels that we were at prior to the pandemic. Again, this is consumer credit divided by disposable personal income. And so, we don't have these credit levels that we did actually, at least not yet, that we had prior to the pandemic. Interestingly enough, looking at this chart, we've got interest payments, again with interest rates moving higher. We've got non-mortgage interest moving up into this 600 billion level, and that's at the point where mortgage interest payments are at right now. And you can see that the trend line here has been fairly strong for mortgage interest payments, and then we've seen a much more accelerated rise in non-mortgage. Again, here you can kind of almost insert credit cards. However, there are puts and takes to everything, and this is something that, in all fairness, I wanted to show, really, again, to provide the same perspective that this does. And this is like your household debt burden is still small relative to historical trends. Both in the non-mortgage and the mortgage sector, even though both of those are spiking, there's a lot of data back here, again, where you had periods of strong non-mortgage and mortgage debt that, caused this burden to be much greater than it is now, even though it is moving higher. Now we'll get into a few labor slides, a little bit of a deeper perspective this week. So we have now 25 straight months of a labor market where the unemployment rate is below 4%. And this goes back to 1948. So you can see that this does not happen very often. This is a very strong labor market, even though we've seen some chinks on the armor. We've seen, job openings go down. We've seen, just here in not too many slides ago, some tempering in enthusiasm for wanting to add staff at a time where productivity is very high. But, suffice it to say, this is a very, very strong labor market. So we also, along the same lines here, on a strong labor market, we've got the number of consecutive positive months of payroll expansion, and we're now at 38. And of course, we had a very long expansion over the last decade. From this perspective, we are falling in line with, relatively strong expansionary periods. But at 38 months, just one more indicator of the strength of the overall labor market. Here we have the hires rate. So this is, the kind of the counterpoint to the last slide. Even though we've got payroll growth, that growth is kind of moderating. We can see that here now. The hires rate, which is seasonally adjusted here, is down around 3.6. Again, we've seen periods, where they've been above, periods when they've been below. This is not entirely, alarming to us. It's just showing you that there is continued strength in the labor market, but some of the froth is coming off just a tad. Here we have non-farm payroll change on a year-over-year basis. Again, still positive, not what it was. But looking at it from a historical perspective, it's kind of trudging along, no inherent signs of just abject weakness yet. So I went ahead and posted this full tweet from Charlie on this particular chart. So we've got non-farm payrolls. And this represents millions of workers. And so the blue line here represents essentially 1.5% a year pre-COVID trend, just kind of a straight line. And so, then we had the pandemic, we had a lot of job losses, and, we've endeavored to recover those. We have bridged the gap, but we're basically still about 4 million jobs light of the pre-pandemic trend. And and the reason I included Charlie's comments is that we, basically have we had almost 2.5 million jobs spread between the number of openings that we have in the market and the number of actual unemployed. So that is still a factor that seems to contribute to the strength of the labor market, notwithstanding the fact that we're still in net demand for workers that we would have hired if we didn't have the pandemic in the first place. Average hourly earnings continue to be strong, coming off their highs. We've been watching this for a number of months now. One of the remaining sticky elements of inflation is always going to be wages, and as this graphic represents here, credit to Charlie and his team. We're now 32 straight months of earnings growth above 4%. Now, the important thing to remember here is that since inflation, as we just saw a few slides ago, is below 4%, then these wages on a real basis are positive. And they have been for some time. As inflation has come down, wages remain sticky. This is good for employees, good for consumption, good for not only net worth but also personal balance sheet considerations. We'll switch to global growth. We've been talking about some of the uneven pockets of growth around the world, and particularly in Europe. We are getting a bit of consensus with regard to expansion here. You can see basically number of bullish here, and the latest reading has really spiked, kind of like riding this chariot of optimism into the entire market, looking out into the balance of 2024. Here we have household net worth, and then we've got real net worth. We obviously have a lot of stocks that are now owned at the household level, so that has clearly gone up. And then equity as a percent of financial assets clearly have gone up as well. It's all helped this whole net worth picture. So even as that gap between net worth and real net worth widens because of inflation, that you're still having net worth growth by virtue of the stock market. And then the last slide we have here today is something quite a bit more educational. It's just the power of compounding. It's the power of getting started early. This is the title of this chart. So basically, if you had invested $5,000 annually and that grew at 8%, and if you started when you were 25 and you just did $5,000 annually, you'd have 1.3 million. And obviously, the longer you wait, the less you wind up having at the end. But there is something to be said, even in this range right here. You know, if you're young and upwardly mobile and can, um, you know, and can put away a little bit of money. And again, 5,000 is not asking a whole lot, but you know, if you can even do that into your 40s and then maybe even increase that amount, you know, there's so much power in the compounding. Uh, of money that it's hard to ignore, but most people don't see it. That's all we have today. Hope you've enjoyed the chart pack and have a great week, safe week if you're traveling on spring break or you're traveling down to South by Southwest. And we'll talk to you again soon.